Good morning, ladies and gentlemen. Welcome and thank you for joining us for our first market update of the year. My name is Justin Davids from Sasfin Wealth, and joining me today is Sasfin Asset Managers Chief Investment Officer, Arno Lawrenz. Arno, I'm going to jump straight into it. We do have some time constraints, but just looking back to 2022, the year that has been, the quarter that has been, to say that it's been a difficult year would be quite an understatement, with the COVID hangover still kind of lingering in the air. It was a year of what felt like multiple crises, and two of the macroeconomic themes that we've been following that have had some of the biggest impact include the inflation story and the reactive nature of reserve banks around the world, which ultimately led to the global cost of living crises that we see today. To where we find ourselves now in the midst of an aggressive interest rate hiking cycle, which we hope we've kind of seen the peak of, or the end of. But in saying that, it's not all doom and gloom, and what often tends to happen is in these dark times, in these volatile times, opportunities do tend to present themselves. So for today, I suppose we'll look at what these could possibly be, your insights, where we've come from to where we're heading. So on that note, Arno, over to you.
Great, thanks, Justin. I was thinking while you were sort of starting there that it's almost 3 years since the hard lockdown started, like March of 2020. So if I look back over the last 3 years rather than just the last year, being a very difficult year as you termed it as well. From a market perspective, it's been very, very tricky, and the life as we know it has been irrevocably changed. I mean, to think that these webinars, for example, I mean, we didn't really do much of them before. Maybe we did a teleconference or something like that, but the way that we communicate and the way that we work has now sort of completely changed. So but that's the point about opportunities and how you adapt, and I think that's really the key, not only for what's happening in the world, but also in terms of what we do in the fund management space as well, and how we adapt the fund as well. I suppose in terms of starting, the one thing that I suppose I could do is, I know it would be called not a cheat sheet but a brag sheet, just in terms of the awards. So just wanted to highlight on the top left there that our high yield fund, our fixed income stable, did win the Raging Bull Award. And again, this fund, I think is I'll touch on it a little bit later as well, is also a key component. I think a lot of people have focused on just the flexible income fund, which has been the sort of through the cycle fund, whereas high yield fund is that sort of floating rate fund, and has done extremely well. And I'm going to chat about it a little bit later as well, but I'll park that. Maybe just leave one thought with the audience is that, when we're managing funds, we're not trying to win awards per se. We're trying to do a good job, and we're trying to, accomplish our investment objective. And if afterwards you win an award, then that's great, but it shouldn't be what really drives you. Okay, so if we take, where do we start from? And we like to start from a macro perspective, and hopefully this picture sort of instills that sense of the big macro. But I think what's interesting about this image is that it shows Africa, and two things that come out of this. Number one is that you can see that South Africa at that southern tip there is very isolated geographically, and that can be a blessing and a curse. So if one thinks about what's going on in Europe in particular, it's good to be far away. We don't have to worry about nukes and things like that. We only have to worry about the guys with the red caps and so forth. And we have our own idiosyncratic nukes, let's put it like that, that we have to be concerned about. So yes, geographically isolated, but if you also look a little bit closer, then we tend to look at just the landmass. But if you look at the weather systems, what it speaks to here is that these are global systems, and we can't escape the global climate type of thing, if I put it like that. And so yes, we are actually still connected, and we are interconnected with what's going on in the rest of the world. So certainly, in as much as what we are geographically isolated, we are still connected, and we are still subject to a lot of these forces. So when you look at and start looking at saying, well, what is going on in the world, and which are the ones that are going to start impacting on us? And this is a chart which, it's one of those complex ones that I'm not going to go through the detail, and the usual PowerPoint thing that there's too much information. But I think what I want you to really show you here was perhaps two things. The one is the fact that there are always risks. You're never going to have a year where they say World Economic Forum 2024 or whatever it is, and then they sort of have a blank page. There are always risks, and there are always going to be issues that bug us and cause us angst, and that need to be priced into markets and into asset prices. And so certainly from that perspective, we need to have a little bit of context in terms of saying, yes, there are certain times when certain of these risks will be realized. In other words, they're not just a risk, but they actually start getting realized. And the one I've highlighted here really was, it's the one with the circle, which is, a debt crisis. So this was highlighted as one of the risks. The size of the little bubbles was supposed to be the size of the risks. So, you can, at your convenience, afterwards, if you really want to do, you could either go onto the WEF website, or you could sort of look at the presentation and have a look at some of these. But these are the elements that we sort of trying to deal with and grapple with from a day-to-day basis. And you can see they're all interconnected, which is sort of really a reference to what we were talking about these systems, because we exist within a global system. And certainly, if we think about some of the risks that South Africa, where they've been realized, and we think most recently about this grey listing, is because we form part of the global financial system. And so being grey listed does have implications for us, and it's been priced into our markets and into our currency and so forth. So, certainly the one that I highlight here is quite pertinent. And the reason why was because when we look back, and Justin touched on, is that, 2022 felt like just a year of crisis. You just went from one to the other. And our message during the course of last year was actually this positioning 2022, and when we were looking ahead, is that, what we were dealing with here was that, it was multiple crises overlapping, and certainly, with no end in sight almost. And so the question I asked at the time, and for those of you that perhaps attended some of our presentation, was, what's the end game here then? With all these, yes, we started with COVID, and there were supply chain disruptions, which caused inflation. The reserve banks and central banks were behind the curve. That induced issues around their credibility, and then they had to ramp up the interest rates very dramatically. There was also the overarching issue of what was going on in Europe with, the Russia-Ukraine story, which induced an energy crisis. That induced some political crises. So there were a lot of these issues happening. And then the question for me was, well, what's the end game? Where does this all lead to? And, we know that the world is not linear. A lot of it is an interplay of different forces at the same time. So when we look at it and say, well, let's look at what the interplay of these forces are. And on the bottom right, you can see crumbling credibility around central banks, the stubborn inflation rates, the pace of interest rate hikes, and the fact that you had a very highly leveraged market condition or economy because of the low interest rates that we started with. And all I'd said was that, you've got all the right conditions or ingredients that you've thrown into the pot. And then what happens with all of that? And I think what we've seen now, most recently was, with the SVB Bank, Credit Suisse, and the sort of TBC, which is not an acronym for another bank, but more sort of, to be continued is the question was, is this crisis that we saw arising over the last month or so, is it over? Have central banks done enough? Did they respond quick enough? And I think the key thing for me here to answer that would be something in the line of, we can never be sure about that because we don't always know what's coming, in terms of these banks. But I think the difference between this time, or let's call it 2023 and 2008, was the speed with which the central banks responded to these crises. Whereas in the case of 2008, it was a bit of a slow burn. And then sort of once it got going, it was sort of too late because they'd left it for so long. But I think, yes, certainly the ingredients were there for something to start falling over, and we may still see some further ramifications and, bank consolidation and so forth around the world. And of course, 2022, you saw this being priced into assets, and across the board, we know, again, across all asset classes really just suffered. So if you weren't in cash or inflation linkers, you probably saw some negative returns there. But again, when we position 2022 as a year of crises, we actually see 2023 as a year of opportunity. And that may sound rather strange because we've just highlighted the fact that there are all these risks out there, and that, where does the end? Does it come in the form of a debt crisis? And I think, what we really sort of want to position this with here is that the reason why we say it's probably a year of opportunity is because, as I've said, there's no year where there are no risks. So, you have a risk premium that is built into asset classes, and we've seen a reduction in the valuation side of things. And certainly what we're seeing here is that a lot of it is in the price. And that's the key thing. So when we got grey listed, for example, you didn't see, South African equities, get blown apart. You didn't see bond yields get blown, higher, or the currency fall apart, so because it was already known that it was coming. So I think when we look at some of these risks on the left, and I won't go through all of the detail here, but really sort of, point to the fact that, these elevated rates essentially create conditions, and by conditions or opportunities is for income investors. From a South African perspective, we've already had elevated bond yields for quite some time. We've now got the short rates moving up as well, and you're starting to see then those short-term interest-bearing funds, come to the fore, which I'll touch on a little bit later. And then I think the backdrop also is, bear in mind that, the China recovery, because they had that zero COVID approach, as I sort of termed it. We exported our lockdown manual to them, and they, followed it to the letter. And then finally, we sent them the updated version, which is that, hey, you can get back to normal. And I think that's what they're going through at the moment. So there's certainly some impetus from an economic perspective in terms of recovery, same as what we saw in South Africa. And then I think there'll be a sort of, again, getting back to normal, which I think in the medium term is going to be positive for South Africa in terms of as an emerging market, as a commodity producer, and so forth. And then I think this geopolitical equilibrium that we will find, has adjusted. And we're going through this sort of realignment between, these three big sort of countries. But I think, again, there's a growing realization that, as uneasy as they are with each other, it's always going to be there. So this sort of growth recovery that you will see as a backdrop to, China or Southeast Asia in particular, plus the elevated rates, plus this sort of new normal, I think does equate in, for us, as we see it, an opportunity here for income investors in particular. If you look at then what one of those big worries is is there a recession coming in the US? And again, if you go back in time and, you use this shape of the yield curve as essentially a indicator, and, this chart really sort of illustrates, going very, very far back, is that if you look at, purely just the blue line, which is the 10-year bond yield less the 2-year bond yield. So it's generally, longer dated bond yields are higher, and shorter dated bond yields are lower. And so when you subtract it, the difference between it. So when you see that those two, a 10-year and a 2-year, being, at the same level, or even where the 2-year goes above the 10-year, if you just think about it, normally you say, well, if I'm going to commit my money for 10 years, I should get a risk premium, right? Because there's all the uncertainty for the next 10 years versus only a 2-year uncertainty. So, in theory, a normal curve should be sort of quite steep. And so that should be a positive number. But when you see this going into negative territory, there's generally speaking, the gray bars there that you're seeing is periods of recession. So typically when you see that blue line going into negative territory, if you look closely, you'll see that almost every time that it does that, it's followed by a recession. And so there's been all this talk about the fact that you've got this big move, into negative territory, and so far there's no recession. So the question has been, why haven't we seen a recession yet? Because, the Fed has been hiking very aggressively since a year ago, and so far nothing yet in terms of recession. But I think, certain segments of the market are now starting to sort of fall over. You've seen what happened in some of the banks, in SVB Bank, for example, so where some of these pressures are coming to bear. And so certainly in our mind, you will start to see this getting closer to that stage. We think at this stage, all the signs are there that it would be a moderate recession, not a severe recession. And I think, one of the reasons why the recession hasn't risen is probably going to become apparent if you look at some of these numbers here, which is really, if you look at, the inflation story, and you can see how inflation has peaked in the US. The Fed has already, hiked aggressively. The key thing here, though, is that the Fed funds rate sitting at around about 5% still is below the inflation rate. So the real Fed funds rate, in fact, is still sitting at a negative level. So if you look at that, and then you go back to the 1980s or early 80s, when you saw how far or how high the Fed had to hike rates, up to 20%, in terms of, and the real rate at that point in time was probably closer to around about 5.5%, compared to today that it's still negative. So in terms of its restrictive nature, and that induced a recession in the US at the time. If I go back to this slide here, you'll see there in the early 80s how you had two quick, one quick recession, short, sharp, and then another one again. And that was really on the back of the inflation at the time being incredibly high. So if I go back, you can see there's the inflation rate peaking out at around about just above 14%. In order to bring that back down to more normal levels, they hiked to 20. Again, if you look at this here closely, you can see inflation peaked at closer to 9% at the moment in terms of where its peak was, and the Fed hasn't yet even got to a positive real rate. And then, of course, how did bond yields respond? You can see this is really sort of, and I won't go through the detail of this here, but really sort of this is the course of the last 2 years where there was a lot of how can I put it, a reluctance to believe that inflation was going to be sustainably higher, all the way through till this time last year, March of last year. And it was only then when the market realized the Fed had got it wrong, that it was not going to be transitory, and in fact that there was going to be a significant inflation surge still coming. And then you saw a big sell-off in the US bond market. Then the oil price also sort of had, post the Ukraine sort of invasion, sort of peaked out, buying into a recession type scenario. And then there's this realization that the Fed is probably going to have to keep rates higher for longer, banking crises. And now that it's sort of, the last number of months has been moving sideways, and essentially saying that embedded within this sort of 3.5% at the moment embeds all of those sort of future risks around recession, which would probably bring rates lower, versus the more inflationary or sticky inflation type scenario. And that's all embedded in that current bond yield. The key thing here, and this is, I'll sort of highlight this because it's not something that happens often in one's lifetime or career, I suppose, and that is when you see South African inflation being below that of the US. So for a long period of time, sort of from the early 2000s, and the last time that SA was below that of the US really was sort of a base effect that sort of came after that early sort of 2000 surge. And again, for a very brief period, we saw SA inflation being below that of the US. So generally speaking, over the last number of years, inflation has been lower in South Africa than the US. And, again, we've sort of, just gone above them now at the moment. And I'll touch on this a little bit later as well. But I think this period of higher inflation in the US than anybody had expected 2 years ago really shocked the market to its core. And so certainly from that perspective, it's been priced into what you're seeing within the asset side. And then SA bond yields, you can see that very attractive double-digit number, 11.35% in terms of a 10-year sort of space. And we've also been moving pretty much in a range. If you want to look at it over this period, you could sort of say, from March of last year till to today, it's a range of 10% at the lower end a year ago to 11.5% peaking out on the top end. And those are, if you think about where inflation is, if I go back one slide and you look at where inflation is, South Africa, 6.9%, and then you look at where the bond yield is, a very attractive real yield from that perspective. It doesn't mean that you are necessarily going to get those returns, because if bond yields went from, say, current levels to 12.5%, you're probably going to lose 6% capital odd, and your income yield would be 8.5%, 9%, so you'd only see a return of 3% for the year. But if you carried on holding it, you would then sort of be able to see that 11.5% return. But again, that sort of rule of thumb that you would tend to use, and what I've touched on here is if you look at it purely on a simple basis, again of a yield to maturity, bond yield at South Africa, 11.25, sort of roughly, and then SA inflation of 7%, and that's current inflation. You're looking at real yield of 4.2, 4.3%. By comparison, the US sitting at around 3.5, 3.6, US inflation at 6, and a negative bond yield of minus 2.5%. So from that perspective, bear in mind that what's embedded then within these numbers is all of those idiosyncratic risks around South Africa, and the reality that it needs to be priced in. So all of the issues about the currency, fears about politics, economic growth, fiscal sustainability, grey listing, I know the list is very long. And then in the case of the US being the deepest and biggest and most liquid bond market in the world, which is also sort of the safe haven in times of uncertainty, is embedded in these prices as well. I won't say price to perfection, and the expectation that inflation is going to be substantially lower than 6% going forward. You've got to be able to take that into account. In terms of the rate cycle for South Africa, and again, the SARB did surprise us yesterday with a 50 basis point hike. Market expectation was that it was 25 or would be 25. They came up with a 50, which, if you look at their quarterly model, their own model, which they publish, that rate that they've now taken the repo rate to is actually above what their own model is showing. So I think what they're trying to do here is essentially, there was a slight upward shift in terms of the inflation expectations going forward, a delay in that core inflation rate side of things. And so certainly I think what they've done is adjusted it to that. But again, all the indications are that because of the environment in South Africa and the growth equation in South Africa, is that it's not a demand-driven inflation story here. And so certainly, between myself and Rafi, when we chatted about it yesterday, we just felt sorry for the consumer in South Africa already, under a lot of pressure, and another 50 basis point hike is not going to do the consumer any good at this point in time. This chart really just, is an interesting one that Rafi sort of found for us, which was that, what it looks at in the number, this is essentially, what we're looking at is the repo rate. And then, how long the numbers that you see, the 16-month, the 8-month, going back, is after you reach the peak, how long before the SARB starts cutting? So each of those numbers that you're seeing there are the number of months after you hit the peak before the rate cuts start. And you can see if you just run through it, the longest was 18 months. There's a 16-month sort of there in 2016. But generally speaking, you're probably looking at somewhere around 9 months. So 9 months from the time that you peak out, that is probably when you see the first rate cut. And that's the nature of the interest rate cycle. So in fact, if we go forward from here, 12 months from here, having seen the SARB hike by 50, we think that is most likely the top. We'd sort of thought if they do 25 yesterday, there might be another 25 at the next meeting, and then we thought that they would be done, and that by this time next year, we might be even seeing the first rate cut. So I think what it speaks to then is, from a fund management perspective, for us, we have to start positioning for that. And for you as investors, in terms of your expectations, is how do I then maximize my income for a long period as time, in an environment in which we now might start thinking about rate cuts. So how do you preserve that level of income at higher levels? Interestingly enough, this was pre-MPC. So before yesterday, the implied the expectation around in the FRA market, which is the forward rate side of things, is that, two things from here was that, generally speaking, pretty much a 25 basis point upward shift with a slight possibility of more. But then the point would be that by, May, June, which would have then been the peak. And then you can sort of, use that previous chart of saying, on average, 9 months after that, which would be March next year, you would probably, on average, then expect to see the first rate cut. And we would suspect, given the trajectory, is that, it's not going to be a dramatic rate cut cycle. So what you're going to see is a very subdued interest rate cut. So it'll be something like 25 basis points at a time, and it could even be spread out over a long period of time. And that really is dependent on, the inflation story in South Africa. And everybody knows the economy is weak. And the fact that the SARB hikes, in spite of that, tells you a lot about their, how can I put it, their desire to have a strong credibility around their inflation credentials. I think it sends a very, very strong message. And that's an important one because, we do exist, as I said, in an interconnected world where, there are other central banks who, have actually, if I think about Turkey, where they've been cutting rates because they've been told to, from a political perspective, whereas the SARB has actually been very, very independent. So I think if you put all of this together, then, a couple of key points come out of this. Number one is global inflation has peaked, but it's probably going to take some time before it gets back to those levels we saw in developed markets, in particular, of like 2%, that sort of thing. So, yes, the interest rate cutting cycle is going to be subdued unless we have some sort of, debt crisis like 2008. And as I said, I think, the speed at which central banks have moved, where there have been these little cracks in the wall, probably speaks to the fact that we're not going to see, a lot of dominoes, sort of falling over. I think those recession risks will remain, as long as these rates are elevated, but again, this is going to be something that the market is going to look at, very carefully. Some people have said hard landing scenario, soft landing, and some people have said no landing, i.e. there's not even going to be a downturn. I think for China, that's going to be a key feature, because it could be the counterbalance to the US, going into a moderate recession where China might actually be in a bit of a recovery mode. So there's a counterbalance there. I think, SARB now, after, yesterday, I think they are at the peak. I'll sort of put my neck out there on the block and sort of say, I think they're at the peak now. And the question will be when the rate cuts start and how do we then position for that? Our systemic failures continue. We know the list is long. And that really speaks to the fact that even though inflation is going to start, has peaked even in South Africa and is going to be declining because you've got a central bank that's so determined to get, a lid on the inflation story, to ensure that it doesn't become sort of a more systemic, feature within our economy, is that get that inflation below 6. I still think our bond yields are going to remain in cheap territory and only moderate gains are likely from that perspective. So what are the expectations? So, we in terms of running through the numbers here, I know this is a busy slide. Thanks, Rafi. You always do this to me. So, the bonds on the top, all the bonds or the Govy bonds that are in the all bond index, from the short dated on the left to the long dated on the right. And then over, 3 months, 6 months, 12 months, in terms of the different rows there, what the expectations are. And this is, this is the bearish scenario. And the reason why it's bearish is if you look at the 3 month number, the 6 month, before you get to 12, is the path that bond yields take is a sort of a more, in the short term, an upward shift. Before it, there's a sort of a recovery, but it still ends slightly higher if you look at the middle, basically. But the numbers you get in terms of the total return, that is income plus any capital loss or gain, you're looking at double-digit returns. This is not the most bearish scenario you could possibly paint. So if, for example, if we go back to the day before for Human Rights Day, that 20th of March, if the EFF March had gotten out of hand and there were more riots and so forth, and you can construct that was a possibility, then sure, bond yields would have been probably substantially higher if we'd had a repeat of the July 2021 type scenario. But again, you can construct, another scenario, which is, Vladimir Putin launches nuclear weapons and, the world falls apart. So these are very low probability, but high impact events. So you can't model for every single last event. But I think here's a sort of in a sense, our bearish scenario, which takes into account the current risks that are out there. Having said that, is the bullish scenario is also a moderate one. So again, if you look at, if I just use, for example, the 2035 in the middle as an example, and if I look at 1, 2, 3, 4 rows from the bottom, you see a minus 64, which is over the course of the next 12 months, we see the 2035s, R2035s declining by 64 basis points. Before that, it still goes upwards before it declines. And that 64 basis points is, from the perspective of, where we are currently, in the sense of that it already embeds a lot of those risks and the fact that inflation, could well follow a moderate fall over the course of the next number of months. If that is the case, the return that you're looking for, well, in the case of the 2035 is, 14.9%, which is, let's call it 15. and then look at across that row, you can see between 9.38 to 17% on average, let's call it around 15, with a range obviously of uncertainty. So on average, if you had to ask us, and push us to sort of say, well, what do you expect the range to be of returns over the course of the next 12 months for bonds in South Africa? And we'd probably say in the range of, 11 to, let's call it 15%. And that is the sort of environment that we're going to be going in over the next 12 months. It's important because when we look at a fund like the Flexible Income Fund, it has the ability to be able to invest into these longer dated bonds, whereas high yield doesn't. So, when you look at the positioning of these two funds, it's going to be crucial in terms of the actual interest rate cycle. The one obviously has the potential to share in these sorts of returns, whereas the other, of course, benefits you from a low volatility perspective. So again, there's an interplay between the two funds, and sort of a highlight that with this slide here. So Flexible Income Fund is a through the cycle fund. It can use different levers. It can use duration. It can use inflation linkers, money market, etc. All of that. By the same token, the high yield fund is a floating rate fund, such that, and we call it floating because it means that, when the SARB hikes rates and the money market rates adjust immediately, so the call rates go up today already, the 3-month JIBAR rate, has also sort of gone up. What it means is that there's a direct impact into the fund in terms of the overall yield. And remember that the high yield fund is the fund that pays a monthly income distribution, whereas Flex only pays quarterly. But again, if there are any capital gains that come through, and you'll see this in the cycle, the Flexible Income Fund is the one that will be able to benefit from this. The key for us then as fund managers is obviously we want both funds to do well in their respective categories and in achieving their investment objective. So certainly from that perspective, we want to do well in both of these funds. At times, Flex might well, because it's been exposed to some duration, you might in the short term see, no capital gain and even a little bit of capital loss come through. But again, for us, we're not trying to manage the day-to-day stuff. We're trying to position for the cycle so that we can maximize the benefit through the cycle rather than in the ultra short term. So just in terms of the positioning of the Flexible Income Fund is that as the cycle has changed, what you want to be able to see, and what we as a asset manager want to be able to communicate to clients here, is that as the cycle changes, we are changing the risk within the fund or the levers that we are pulling in order to deliver return. So if you go back to December 2020, for those of you that can remember, December 2020, still a low inflation world, low interest rates, and in a global context, almost zero or negative interest rates. And so what you saw that, your levers that you had to pull in terms of being able to deliver return were somewhat limited. So really you could focus on low volatility, i.e. sort of floating rate assets, as well as a bit of a search for yield. So you would go and say, well, what bonds are there in the corporate bond market and so forth that I can use in order to deliver a real yield through time. So that was, 2020. I won't go through all the detail of it, but essentially then what we saw was this inflation surge, and a very aggressive, global central bank response to that by hiking interest rates. And what you then see, with the fund as it stands at the moment is, obviously there's an explicit duration strategy within the fund, i.e. we are now starting to position, if I go back, one slide, you can see that fixed rate component of 51% in that dark bar. And, that is investing into, let's call it longer dated bonds. So when we see the elevated levels that we have at the moment and those prospective returns of, let's call it, say, 15%, then as we look through the cycle and we say, well, we can deliver in Flex by investing into that, an explicit duration component, by investing in long dated bonds, we can deliver the sorts of returns which are well in excess of inflation. The question around inflation protection is dissipating. So if you go back to August of 2022, up at the top there, the inflation protection, now sitting at probably less than 1%. We are at the moment, where we were at about in August last year at about 10% explicit inflation protection. But because inflation has peaked in South Africa, and bond yields are already embedding some of that inflation risk, we're starting to see better value in pure nominal bonds. And so we've shifted to that. There's still a yield component in the fund, and then there's a low volatility component to the fund. And again, when we start to think, forward over the next 12 months, what are the risks that we could start seeing where, in as much as what we are sort of cautiously optimistic we need to ensure that you don't put, all your chips on red or black, if I can put it like that. So you need to have different strategies within the fund, depending on what the market circumstances are. And the way that we really sort of encapsulate that is in that philosophy and mindset that we have, which is right at the bottom there, which is taking the appropriate investment risk at the appropriate time. So determine where you are in the cycle, and then based on that, you should then position the fund accordingly. Obviously, credit risk, I touched on the duration risk, but I think credit is also, again, very clear to see here, where you could see on the right in December 2020, quite an exposure to the credit markets, if you want to put it like that. Whereas if you look at it today, is pretty much 71% of the fund sitting in AAA. So there's a distinct shift, and what we're trying to illustrate to you here is a distinct shift in not the style of the fund, but in the levers that we're pulling at the moment, because the cycle has changed and shifted from where we were 2-3 years ago. And then I think one other risk that is always the forgotten risk, which is liquidity. So in terms of the active management of the fund, there's one key thing here, one constraint that we as fund managers have, which is that if you invest everything that in the fund into illiquid securities, and you see the market changing, or you say your view has changed and expectations have changed, how do you then adjust the fund in order to take advantage of that if you don't have liquidity? So if you go back to December 2020, and you can see that because we were investing in a yield pickup type strategy, those bonds tended to trade less, and so their liquidity was lower. And as the cycle has shifted, and as we now start positioning ourselves and looking forward to saying, we want to be able to, on behalf of clients, to maximize the return out, or maximize the benefit of that peak of the interest rate cycle, we want to be able to, essentially lock in that by investing in, for example, into fixed rate side of things on Flex, and in high yield by perhaps investing into longer dated floating rate notes. And the way that we can do that then, is by essentially looking at our liquidity risk and ensuring that we have the ability to shift the fund as the cycle changes. So I think this is an important and crucial aspect of fund management that sometimes gets a little bit lost, and we don't take cognizance of that. So it's important for us to be able to demonstrate that. So I think if I bring this all together and sort of then open up for perhaps any questions or issues that we might want to talk further, I think these high bond yields, they are very much an opportunity, a boon for income-seeking investors. So in as much as what we bemoan the fact that fiscal sustainability issues, credit rating in South Africa, they've given us this opportunity of high bond yields, especially on real terms against inflation. I think the SA financial system is very robust, and it's important that I make this point here because there have been questions around, okay, these banks are starting to fail. If you see even a Credit Suisse failing, what about the South African financial system? And I think I've said there, see 2008. Well, we had an almost global financial system meltdown in 2008, the whole Lehman moment and so forth. And I think the key there, was that, if you look at what South African banks did in 2008, at no stage was any of the banks in South Africa in danger of falling over, even though the rest of the world's financial system was going into sort of meltdown mode. And yes, the bank shares locally also fell, but there was no issue that the SARB had to address at that point in time. So I think it's also important to say that at this stage, there's no need to increase credit risk in our fund in the South African context at this point. Why? Because those bond yields are so high already. There's no need for me to chase performance by taking on additional risk when I'm already getting an 11.5% return out of SA 10-year bond yields. For me, that is about risk management and ensuring that the returns I get mean I can sleep easy at night, and I don't have to worry about, if there's some dominoes that are going to fall in the South African context. I think these uncertain outcomes does mean a shift in terms of the liquidity. So certainly we are pre-positioning. And then I think, again, just this point about, yes, we've got high bond yields, but you're not going to see, bond yields in South Africa go from 11.5 to 9.5. And if they did, you would see returns closer to 20%. I don't think that that's on the cards. There are just too many of these sort of risks that are out there that need to be priced into the asset side of things. And then one last point will be on the currency, which I think, the point is that the dollar has had all the tailwinds of a very aggressive Fed, a flight to safety, all of those things, whereas the rand has had the opposite in a sense. But I think, certainly from that perspective, we're starting to see an investment thesis emerge that we may well have a period in which the rand could well be a little bit stronger. And certainly after the SARB hiked by 50 yesterday and surprised the market, we saw a positive reaction in the rand, where the rand had actually strengthened. I think I'm going to park it there. I don't think I've got any more slides, so happily leave it there and then open it, Justin, to you. And if there are any particular sort of questions, I think I see there in the Q&A, the one is, do you feel we're at the peak of the interest rate cycle? I hope that I've answered that question. I think, I think we are. I don't see a need for the SARB to hike again. I think it was very much, as I termed it yesterday, that hike of 50 was a punch to the gut for South African economy. And I think that's one last punch to the gut, and now we're done. I think, certainly, unless there's a deterioration in the inflation outlook, and again, bear in mind that the South African inflation story is not driven by the local economy. It's driven, we're a price taker. So it's got to be something like either the oil price blows out, or there's a global food price issue driven by some event around climate or whatever the case might be, or it would have to be the currency blowing up. Those are the three drivers of inflation in the South African context: oil prices, food prices, currency. And so from that perspective, we feel that we're pretty comfortable, and all the forecasts are pointing to inflation sort of peaking. I think the SARB is going to wait for core inflation in South Africa to start rolling over, and then I think this time next year we might well see the first rate cut. Yeah, any other?
No, Arno, thank you. Insightful as always. We've unfortunately run out of time. Excuse me, but today's session, it will be made available on most public forums, social media. You can follow Sasfin on LinkedIn. If you'd like access to similar content, check out our content hub on sasfin.com as well. If there are any further questions following today's session, please do reach out to your business development representative. Arno, again, ladies and gentlemen, thank you very much. We'll be doing more of these types of sessions, and we look forward to the next one. Thank you very much.
Great. Thanks very much, Justin. And thanks to the audience, and especially to Olga as well for organizing.
Oh, yes, of course. And thank you to BCI, our partners at BCI.